It's time now for the big picture. So let's welcome in Michelle Gibley, Director of International Equity Research and Strategy, Schwab Center for Financial Research. Thanks so much for your time this morning, Michelle. It's so nice to see you. Happy Friday. Look, we started this week off with a more hawkish tone coming from the governor of the BOJ, and that put very much the carry trade back in the spotlight. We've seen the higher yield stateside being pressured by those JGBs. I'm seeing that the expectations now are building of a rate hike very much in Japan. What does this mean now for global equities?
Yeah, despite the concerns about government meddling in monetary policy, we're seeing the Bank of Japan looking at more likely hike rates this month. And, if you think back, Takaichi, she was not supportive of hiking rates and then added a big fiscal stimulus. And we saw the yen reverse nearly all of its strength in November, nearly all the strength that they had earlier this year. And so if the Bank of Japan delayed hikes and allowed the yen to weaken, that could actually increase inflation and then intensify the need to hike rates eventually. So the logical choice for both the Bank of Japan and Takaichi is to allow rates to rise to keep inflation in check. In terms of Japanese stocks, they have some good things going for them. They're benefiting from corporate reforms to improve governance and capital management, and they are attractively valued. But, there's been this negative correlation between the yen and Japanese stocks. So investors may want to consider currency hedge vehicles when investing in Japanese stocks. And then if you think about more broadly, I think there's some concern about a yen carry trade or unwind of a yen carry trade. But we're really in a very different position now than we were in August of 2024. Back then, speculative traders were positioned very extremely short. And what happened is we saw that short covering happen and really resulted in some forced trading. And now we are in a different position. Speculative traders are more long yen, they're net long yen. So we're unlikely to repeat that volatility. So it's possible that the Bank of Japan hikes and JGB yields rise, and it could hurt risky assets globally, but it's likely to occur really over a more gradual pace.
Mm-hmm. We had somebody on the program earlier this week talking about how there's still about $1 trillion invested in the trade, which, of course, for those who are unfamiliar, is a popular trade used to borrow yen and then obviously invest in riskier assets here like Bitcoin and also technology. He was talking about the potential for the unwind creating a 10 to 20% correction in the AI trade. I know you say it's different this time, but is there still a risk here?
I think what's interesting is that the threat of the Bank of Japan hiking is actually hurting Japanese stocks overnight, but it's not really having an impact on trading here in the U.S. today. I think there is some risk, but I really don't think that it'll be, the same kind of situation we were last year.
Okay, what about treasury yields? Because interestingly, Societe Generale was out with a note earlier this week as well, talking about how this hawkish move from the BOJ is actually a bigger threat to U.S. equity market than the Federal Reserve or U.S. domestic policy because of the possible contagion in U.S. treasury yields. And some of the guys over at Fixed Income at Charles Schwab have been talking about how, obviously you have to look back to the GFC to see the 2-year JGB at these levels. And obviously the 10-year JGB, it's highest since 2007 overnight as well. I'm just wondering if you continue to see whether that will keep a floor under U.S. yields as well.
Yeah, I think that our fixed income team believes that the yields in the U.S., what we're seeing is this compression of the differentiation between interest rate differentials. And so the more likely that the Fed cuts rates and the Bank of Japan hikes, that could narrow the yield spread, and that would hurt the dollar, and that would benefit international stocks.
Okay, just want to talk about, or are we moving on? I believe we are moving on. Or We just want to talk about valuations, Michelle, before we let you go. As far as international valuations versus what we're seeing here stateside, it's been interesting overnight seeing this Morph Threads company over in China, which is sort of dubbed China's NVIDIA, rallying almost 430% on its debut over in Shanghai. I was looking at the star market there, which is their sort of NASDAQ, trading at about 120 times earnings, whereas the Shanghai composite is trading at about 12 times, which is certainly interesting. But where are you seeing as far as international valuations that look attractive right now?
Yeah, I think you could say that, maybe not that individual company, I don't follow them, but Chinese stocks, emerging market stocks are still attractively valued. And there is a lot of optimism about AI in China. And as we're seeing adoption increase and innovation happen, and we have this trade truce between the US and China, and that could maybe boost valuation for Chinese stocks if worries about the potential for Chinese companies to be targeted by the US eases. And then, if we look over in Europe, stocks are very inexpensively valued. The discount to the US is about 30 to 35% across every single sector, and yet earnings growth is set to accelerate dramatically next year. Earnings in the Eurozone going from flat this year to nearly matching the earnings growth in the US. And so investors are likely underweight international, and there are really good values to be had overseas.
We'll be looking at 2026, Europe, obviously something to keep an eye on as well. We have seen a bit of an outperformance this year as well, certainly at the start of the year, looking pretty strong there too. Michelle, always a pleasure. Thanks so much for your time today. Have a great weekend. We'll catch you next time. Michelle Gibley, Director of International Equity Research and Strategy, Schwab Center for Financial Research.